Gold and silver are not just going up. They are repricing in real time because war risk is spreading, oil is surging, and global markets are starting to realize this is not a temporary headline cycle. This is the kind of moment that changes capital flows fast. Money is leaving assets that depend on calm and moving into assets built for chaos. And that is why this move in gold and silver matters far more than most people think. What happened is simple on the surface and dangerous underneath. Geopolitical tension pushed traders to reprice energy. Oil reacted first because oil always reacts first when supply routes, production hubs, and transport corridors look vulnerable. Then currencies started wobbling. Then bond traders began asking the most important question in any crisis. If energy stays high and uncertainty spreads, what exactly do central banks do next? That is where gold and silver enter the story in a very different way. Most people still treat gold as a fear trade and silver as gold's smaller cousin. That is too simplistic for what is happening now. Gold is not just fear, gold is distrust. It rises when investors stop believing that governments, central banks, or markets can smoothly absorb the next shock. Silver is even more explosive because it sits in two worlds at once. It trades like a monetary metal when confidence falls, and it trades like an industrial metal when inflation pressure and supply stress start bleeding into the real economy. That is why silver can look slow and then suddenly go vertical. And that is exactly the risk in this market right now. Many investors are still looking at yesterday's logic. They are saying war headlines come and go. They are saying oil spikes usually fade. They are saying central banks will calm things down. Maybe. But what if this time the shock is not the headline itself? What if the real problem is that war is arriving at the exact moment the global system is already stretched by debt, fragile growth, sticky inflation, and crowded positioning across traditional assets? That is where the move gets interesting. Because if oil stays elevated, it does not just hurt drivers at the pump, it bleeds into shipping, manufacturing, agriculture, airline costs, plastics, chemicals, power generation, and consumer expectations. It works through the entire economy like a hidden tax. That means one oil shock can create two different market panics at the same time. The first is growth fear. The second is inflation fear. When both happen together, the normal playbook starts breaking apart. Usually, weak growth helps bonds. Usually, cooling growth helps rate cut expectations. Usually, stocks can tell themselves that bad news means easier money is coming. But if the bad news is oil, and oil is pushing inflation back up while growth is weakening, then the market walks straight into the most uncomfortable setup of all: stagflation risk. And when investors start whispering that word again, gold suddenly stops looking expensive. That is the part many people are missing. Gold does not need a total collapse to move. It just needs the market to lose confidence in the old assumptions. If investors no longer trust that inflation is fully under control, gold gets a bid. If they no longer trust rate cuts will solve the problem, gold gets a bid. If they start fearing currency weakness, sovereign stress, or a policy mistake, gold gets another bid. Put all of that together with war-driven oil strength, and you have the exact environment where capital starts moving before the headlines catch up. Silver then adds a second layer of tension, because silver rarely moves in a calm, orderly way. It sleeps through part of the story, then violently catches up once the market senses the move is real. That happens because silver is smaller, more volatile, and more emotional. When investors start chasing inflation hedges, monetary hedges, and hard assets all at once, silver can accelerate faster than gold. But it also scares people more, because the swings are sharper. That volatility is not a side note, it is part of the story. So if you are only looking at the daily chart and asking whether this is just another temporary war trade, you may be looking at the wrong thing. The deeper question is this: are gold and silver reacting to a headline, or are they reacting to a change in the regime? Because those are not the same move. A headline trade fades when fear cools. A regime shift keeps going because the market starts repricing everything around it. Energy gets repriced. Inflation expectations get repriced. Bond yields get repriced. Currencies get repriced. Central bank credibility gets repriced. And once that chain reaction begins, gold and silver stop behaving like niche assets and start behaving like warning lights. Now think about where global markets already were before this latest shock. Growth was not strong enough to feel safe. Debt levels were already huge. Governments were already spending aggressively. Many consumers were already under pressure from higher living costs. Several major economies were already trying to engineer soft landings with very little margin for error. That means this is not a clean system absorbing a shock. This is a fragile system taking another hit while pretending it is stable. That is why oil matters so much here. Oil is not just a commodity. It is the bloodstream of the modern economy. When it spikes on war risk, the market is forced to price in the possibility that the entire cost structure of the global system is about to rise again. That affects corporate margins. It affects freight. It affects food. It affects the inflation data policymakers are desperately trying to calm. And if policymakers respond too slowly, inflation expectations rise. If they respond too aggressively, growth cracks. Either way, confidence weakens. Gold loves that tension. Silver can love it even more, but only after the market realizes the squeeze is broader than one sector. And here is where the hidden risk gets bigger. Investors often assume war helps gold because gold is safe. True, but incomplete. War can also damage industrial supply chains, disrupt shipping lanes, harden sanctions, distort currency relationships, and force governments into new fiscal spending. That matters because gold benefits not only from fear, but also from the long-term financial consequences of conflict. Military spending rises, deficits widen, energy costs stay unstable, insurance costs jump, supply chains get redesigned. All of this slowly undermines the illusion that the world can return to the old, low-volatility environment on demand. Once that illusion breaks, portfolio behavior changes. Large investors who ignored precious metals for years start revisiting them. Central banks that were already buying gold as a reserve diversifier have even more reason to keep buying. Retail money, which usually arrives late, starts noticing the price action only after the early move is already underway. Then financial media begins covering the rally as if it came out of nowhere, even though the ingredients were visible long before the breakout. That late recognition phase is critical, because the first move in gold is often driven by caution, the second move is driven by conviction, the third move is driven by fear of missing out. Silver tends to lag that first move, then overreact during the second and third. So when people say gold and silver are moving fast, the real question is not how far they have already gone. The real question is whether the market has fully priced the chain reaction behind the move. And the answer, in many crisis environments, is no. Why? Because markets hate nonlinear outcomes. They are comfortable pricing a small oil spike. They are comfortable pricing a brief risk-off wave. They are comfortable pricing one central bank pivot. They are much less comfortable pricing a world where war pressure keeps energy elevated, inflation gets sticky again, growth slows, deficits rise, and confidence in paper assets quietly erodes at the same time. That combination creates the kind of slow-burn panic that does not always show up in one dramatic day. Sometimes it shows up as a series of stubborn moves that keep refusing to reverse. That is how big commodity and precious metal trends often begin, not with one giant explosion, but with a market that keeps expecting relief and never quite gets it. Imagine what happens if oil remains high for longer than traders expect. Companies start warning about input costs. Consumers feel the squeeze. Shipping costs push through supply chains. Inflation data stops improving. Rate cut hopes get pushed back or become less powerful. Equities that were priced for smooth policy support suddenly look vulnerable. And in the middle of all that, gold keeps holding strength instead of giving it back. That is when the market starts understanding that something deeper is happening. And if gold holds, silver gets very interesting very quickly. Because silver does not need perfection. It just needs pressure in the right direction. If gold confirms the macro fear, and if markets begin searching for harder inflation hedges with upside torque, silver starts attracting a very different type of buyer. Not just safety buyers, momentum buyers, macro traders, breakout chasers. The people who were bored during the early phase suddenly become very interested. That is when silver's speed can surprise everyone. But there is another piece of this story that matters just as much. Trust. Every major market cycle eventually becomes a trust cycle. Do investors trust governments to control deficits? Do they trust central banks to protect currencies without breaking growth? Do they trust financial markets to price risk honestly? Do they trust that conflict will stay contained? Gold rises fastest when the answer to several of those questions starts shifting from yes to maybe. Silver then rides the emotional spillover from that change in trust. And right now, that trust is being tested from multiple angles at once. War threatens stability. Oil threatens prices. High debt threatens policy flexibility. Slower growth threatens earnings. Political polarization threatens credible responses. Currency volatility threatens purchasing power. None of those forces has to explode on its own to create a gold story. They simply need to overlap. Once they do, the market starts reaching for hard assets not because it is irrational, but because it is trying to insure against a world that suddenly feels less predictable. That is why this is not just a precious metals story. It is a global macro story. Gold and silver are moving because they are sitting at the center of a bigger repricing. They are reacting to the possibility that the next phase of this market is not disinflation and calm, but instability with consequences. If that is true, then the move in metals is not the event, it is the message, and the message is uncomfortable. It says the system may be less resilient than it looks. It says energy remains powerful enough to shake policy, growth, and inflation all at once. It says geopolitical stress is no longer background noise. It says the market may have spent too long assuming every crisis will be brief, local, and easily managed. That assumption worked for a while. It becomes dangerous when multiple risks begin feeding each other. This is where complacency becomes expensive. A lot of investors still think of gold and silver as old-world assets with limited relevance in modern markets. That view keeps getting challenged every time inflation returns, every time currencies wobble, every time governments overspend, and every time geopolitical stress reminds the world that hard assets do not rely on promises. Gold does not care about earnings guidance. Silver does not ask for central bank credibility. They respond to pressure in a different language. And right now, that language is getting louder. If oil cools quickly, if conflict de-escalates, if inflation keeps falling, and if growth holds up, then yes, some of this move can cool off. That is the optimistic case. But markets do not pay for certainty. They price probabilities. And the probability that this shock leaves a lasting macro footprint is much higher than many traders want to admit. That is why metals are being repriced with urgency. Not because every worst-case scenario is guaranteed, but because the range of outcomes just widened. Wider outcomes force different behavior. Fund managers hedge more. Central banks diversify more. Traders reduce blind faith in rate cut narratives. Households start noticing purchasing power again. International buyers start looking at gold through the lens of currency defense, rather than simple speculation. Each of these flows looks small on its own. Together, they create persistent demand. Persistent demand is what turns a spike into a trend. That is why the speed of this move matters. Fast moves in gold and silver are not just about price. They are about information. They suggest the market is digesting something faster than the average headline reader. They suggest some participants are already positioning for a world where inflation is harder to contain, policy is harder to trust, and geopolitical risk has become financially unavoidable. By the time everyone agrees on that story, the easy part of the move is often already gone. And that is the bigger implication almost nobody wants to say out loud. If war and oil are now strong enough to shake global markets this aggressively, then the next stage may not be about whether precious metals should be in the conversation. The next stage may be about how under-owned they still are relative to the risks building underneath the system. Gold has already started telling that story. Silver may be preparing to shout it. There is also a timing issue the market may be underestimating. Precious metals do not wait for official confirmation. They move when investors sense that policymakers are falling behind the curve. By the time inflation data fully reflects higher energy, by the time earnings calls openly warn about margin pressure, by the time economists upgrade recession odds and television panels start debating stagflation every night, gold is often already much higher, and silver is already much more volatile. That delay between reality and recognition is where the biggest moves are born. And that delay is exactly why this setup can become dangerous for anyone treating it like a normal commodity bounce. If traders dismiss this as just another temporary risk headline, they may wake up to a market that has already shifted from tactical fear to structural repricing. Once that shift happens, pullbacks stop feeling like relief. They start feeling like reload zones for bigger money. So where does that leave us? It leaves us in a market that is suddenly being forced to respect old rules again. Energy matters. Geography matters. Inflation can come back faster than models expect. Central banks are not all powerful. Cheap assumptions about stability can break, and when that happens, hard assets stop looking old-fashioned and start looking necessary. That does not mean every day will be green. It does not mean volatility disappears. In fact, if this thesis is right, volatility probably gets worse. There will be pullbacks, fake-outs, scary reversals, and moments designed to convince people the move is over. That is how major trends behave. They do not climb in a straight line. They climb by exhausting the people who do not understand why the move exists in the first place. That is why watching only price can be misleading. Watch oil. Watch inflation expectations. Watch bond behavior. Watch currencies. Watch how central banks talk when energy starts threatening their progress. Watch whether gold gives back strength or keeps absorbing every attempt to knock it down. And most importantly, watch silver when gold refuses to break. Because that is often where the next acceleration hides. The market is entering a phase where the old comfort trade is being questioned. War is no longer just geopolitical theater. Oil is no longer just another chart. Together, they are testing the entire architecture of global confidence. Gold and silver are responding because they can see the stress before many investors are willing to name it. That is the real story here. Gold and silver are moving fast because global markets are being forced to confront something they hoped was behind them: the return of real-world constraints, energy constraints, policy constraints, geopolitical constraints, confidence constraints. And once markets start pricing those again, the move in precious metals can become much larger than the average trader expects. Because in the end, this is not only about war. It is not only about oil. It is about what happens when a fragile financial system meets a shock it cannot easily neutralize. That is when capital stops chasing comfort and starts chasing protection. That is when old stores of value become new priorities. That is when gold stops being optional, silver stops being ignored, and the market starts repricing risk the hard way. The headlines may make this look sudden. It is not sudden. It is accumulated stress finally finding a price. And if that repricing has only just begun, then the fastest move in gold and silver may not be behind us. It may be the warning shot.